strong payrolls, sticky prices, and a Fed that looks locked in until fall, plus a shiny new US-China trade deal. I'm Johanna Bota, and here to break it all down for us is StoneX's Chief Commodities Economist, Arlan Suderman. Welcome back, Arlan. Always great to have you with us. Let's start by going back to the latest jobs report. So, non-farm payrolls topped expectations, but the bar was set pretty low. How do you interpret those numbers?
Well, what matters is how Wall Street interprets it, and then I'll kind of give my interpretation. Wall Street interpreted it as, hey, it wasn't as bad as it could have been. In fact, it was better than feared. And so that was a positive reaction to it. The unemployment rate holding at 4.2%, um, and roughly 130,000 jobs created. So we're moving forward. Now, if you break down the numbers a little bit more deeply, we see that those jobs, a lot of them are in hospitality and in healthcare, leisure, hospitality, and healthcare. Still not the high-paying jobs that we would like to see overall coming into this. But we also saw a massive exodus of people from the job market. I think it's around 650,000 people or so. Had those people not exited the job market, the unemployment rate probably would have been closer to 4.6 or even 4.7%, which the market would have interpreted much differently. Now we have to watch this in the months to come to see where it goes. And for now, though, it looks like in the eyes of Wall Street as a pretty tame jobs report saying that job market's in a healthy course.
Now, on Wednesday, U.S. inflation data came in lower than expected, but let's look at the details. Headline inflation rose to 2.4% year on year, one notch up from the previous month figure, and core CPI, which excludes food and energy prices, held steady, which tells me prices remain sticky. Is that fair to say?
It does mean that prices remain sticky. Now, a lot of that stickiness is in the service sector. The goods inflation seems to be relatively low overall. We're seeing some certainly decline in energy prices during the month of May. That will change in the month of June, it looks like. Some decline in food prices as well. Egg prices continuing to work their way lower. Meat prices remaining high. But overall, goods were generally low, much lower than what the trade expected, considering the tariffs that have been put on by President Trump and some of the retaliatory efforts taken particularly by China overall. But that probably starts to show up more in the hard data as we go forward. So for now, the inflation data continues to trend very cool relative to what trade fears were. And so therefore, Wall Street sees that as a positive, that it gives the Fed some room to cut interest rates down the road if it would like to do so.
hmm Now, this recent data, NFP plus CPI, seems to have confirmed the market's opinion that no Fed cut is to be expected before the September meeting. Would you say that's an accurate statement?
Yeah, absolutely. And I'm not convinced it'll happen in the September meeting. As I indicated, the inflation data does seem to give them the leeway to do that. But some of the underlying concerns in the job market, and particularly as we look at the recent increase in weekly claims for unemployment benefits, and the continuing claims number is climbing higher. If that continues, then that will start putting pressure on the Fed to lower interest rates further. Now, we're still 4.2% unemployment rate is still one of the lowest in history, looking back all the way to 1970. It's rare that we see the unemployment rate that low. But the Fed kind of interprets it differently than what it once did, and it doesn't allow much room. So if we get up 4.5, 4.6, 4.7%, the Fed's going to want to act and lower interest rates. The other thing that creates some questions is when will the inflationary effect of the tariffs finally start to take effect? Will that start showing up? And what about the geopolitical risks that are rising? What impact might that have, particularly with energy prices rising during the month of June? So I think as we look at next week's action, the Fed does nothing. We'll be listening to members of the Fed's comments, Fed Chair Jerome Powell's comments in the press conference afterwards. How are they thinking about this? Probably not in the July meeting either. but the September meeting is what the market's going to be looking toward again.
So we know that lower interest rates can have a positive effect on GDP growth. Yet, like you just mentioned, and I just mentioned, the Fed seems parked despite President Trump's push. So what's your take on Wednesday's US-China agreement from an economic standpoint? And what might it signal for the long-term relationship between the two countries?
China and the United States are obviously big trading partners. We're the largest consumer market, followed closely behind by Europe for China to be able to access. China's built its economy on trade surpluses with the United States and with Europe in order to funnel money into their economy. That was largely shut down. With the 90-day rollback in tariffs, that allows some of that trade to happen once again, albeit still at relatively elevated tariff levels. They're low enough that that trade can happen. So that does allow some injection of growth in China's economy once again. It does allow some growth in the US economy once again. But it still comes down to rare earth minerals. That's what China is driving it to right now. That's their leverage point. And the latest trade agreement that they reached, they agreed to upfront start opening up rare earth minerals to move to the United States for auto production. That keeps our plant lines going, which were on the cusp of shutting down. That's positive for our economy. But that was only, according to industry reports, for 6 months. China is continuing to keep the rare earth minerals as their leverage point in these negotiations. And everything that China is doing, everything they're saying, what we're reading in state media in China indicates that they're looking for prolonged negotiations to drag this out, hoping that President Trump loses one of his legal battles in his ability to be able to wage this tariff war, and they won't have to give up anything at all. And so right now, I think it's going to continue to be an overall drag on the economy, although we are seeing consumer sentiment pick up as the consumers are starting to become accustomed to this, that the world hasn't come to an end. The stock market certainly has been within, prior to the attack on Iran, was within a stone's throw of record high prices. Wall Street's becoming accustomed to it. So the economy is resilient. You look at GDP overall, minus 0.2% in the first quarter of the year, largely because of a hoarding of inventories ahead of the tariffs. But the projections for the second quarter, 3.8%, as we pull down those inventories. Have to average them together. We're probably looking around 2% GDP for the first half of this year. And that's still solid growth, although I think it could be higher.
Thank you for your time, Arlan. And thank you for watching. For more financial content like this, please like and subscribe to our channel.